welcome to the Capital Discussions Roundtable. I'm Tom Nunnermaker with Jim Riggio, and this week our guests are the Quanti Carlo team, Larry Richards and David Wilt. But before we get started, we have a quick disclaimer. The Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this disclaimer is at the bottom of all of our web pages if you care to read it in detail. So with that, while we're changing presenters, welcome Larry and David, and for people who don't know you, Jim and I have known both of you for a while, but maybe you want to have a little introduction of who you are and what Quanti Carlo is about.
Okay, well thank you, Tom. This is Larry Richards speaking. Am I sharing my desktop right now?
You have the presenter, so you'll have to click the button to share your desktop.
Okay. I'm Larry Richards, as I said, and I'm coming from the Sheridan Options mentoring background. That's my education. And my co-founder and partner is here today, David Wilt, and he's going to speak a little bit later about how he has been using Quanti Carlo Enterprise Edition to solve some real-world problems, and he'll present a case study. I'm very excited today to announce that Quanti Carlo is a new service that we're actually launching today. It's software, it's a service, and I want to tell you a little bit about what it is. I want to tell you about what benefits it has for you as a trader, and I want to tell you where to find more information, and I want to actually show you a little bit of the program itself so that you get just an idea of what it is visually. And then we'll have the opportunity for question and answers. Does that make sense so far?
Sure does. And you can share your screen anytime you like now, Larry.
Okay, I'm looking for the share screen button. All right, so let me enter full screen mode here. Just to tell you a little bit about Quanti Carlo. Quanti Carlo is about efficiently evaluating and optimizing option trades. And the purpose is simply that, to enable option traders, like presumably all of you, to efficiently evaluate and optimize your trading strategies. And we want to foster a community of option traders that's dedicated to scientifically sound trade optimization best practices. Now that's a mouthful, and you might wonder what I mean by that. And my colleague David is going to explain a little bit more about scientifically sound optimization and what that means. I don't think the definitive book has been written yet about how to optimize an option trading strategy. There have been books, and David will mention one of them that we refer to quite a bit. And one is by Robert Pardoe, and it's a classic. It's called The Evaluation and Optimization of Trading Strategies. This one is about trading the underlying asset. So it's not about options per se, but a lot of the principles actually apply. And David will have more to say about that. But I also like a book by David Aronson. It's called Evidence-Based Technical Analysis, Applying the Scientific Method and Statistical Inference to Trading Signals. And essentially, one of the things that he says, what David Aronson says, is that there's a difference between information and knowledge, okay? And backtesting is a way of obtaining information. It's also a way of obtaining knowledge if you have the right practices, if you have the right methodologies. So, you know, one of the things that David Aronson says is that you've got all statements, and then you've got well-formed declarative statements, you've got true statements, and then a subset of all of that is knowledge. So what we're looking for is to find best practices that get us from the information, all the information that you can gather using backtesting that could be a candidate for knowledge, but and then actually distill that into knowledge that's going to allow you to be more profitable. Okay, and I think going back to the previous slide, a key to this is having a community of people to actually discuss and share best practices, and that's one of the things that we're aiming to do. If you go to quanticarlo.com, you will find that you can become a member for free, and you can actually discuss in our forums. So next, let me just tell you a little bit about Quanti Carlo. Let's see here. So version 1 of Quanti Carlo focuses on automated backtesting for non-programmers. So essentially, you can tweak and run pre-built trading plans, or you can build your own trading plan using symbolic expressions. And we've developed a sort of symbolic expression language that you don't have to know anything about programming languages in order to use. And we've tried to make it so that the non-programmer will be able to use it out of the box, okay? The data that we have is options data on U.S. equities and indexes from 2004 in 15-minute increments, okay? And by the way, we're getting that from LiveVol, which I'm sure you're familiar with. LiveVol is a frequent visitor to this, frequent guest on this capital discussions, as I understand. And Quanti Carlo, as I said, is launching today. Anyone can start using Quanti Carlo right now. It runs on Windows. We've tested it on Ubuntu Linux. It might run on other forms of Linux, but at least it runs on Ubuntu. And it runs on Macintosh OS X, which is what I'll be showing it to you on today. We have 15 tutorial videos, which is more than an hour. They're about 5 minutes each, some of them shorter, some of them longer. And I encourage you to please go there and check those out. You'll learn a lot more about Quanti Carlo by watching these tutorial videos than you will by listening to me talk today. So I'll just show you, this is the web page, and we have some tutorials on installation, and then we have some introductory series here, system overview, using the graphical interface, etc. And then we're starting an intermediate series as well. There's only one video there at the moment. But these are going to be growing day by day, so I encourage you to please go and watch those videos as you download the software and try it out yourself. So you can start a free trial at quanticarlo.com, and let's see here. Let me go back to full screen mode. Let's see here. So we have 4 subscription levels. Now, the one that David is using is Quanti Carlo Enterprise Edition, which has dedicated servers. So the way Quanti Carlo works is actually the more servers, you can add more power by adding more servers. And the more servers you add, the faster your backtesting happens because everything runs in parallel. And so with Quanti Carlo Enterprise Edition, you have your own dedicated servers, and you can have access to Java and Python scripting. We have 2 APIs for those of you who are programming geeks like me. So these scripting APIs enable you to automate everything that you can do using the graphical user interface. Now, in addition to these, we have Quanti Carlo Free Edition. Quanti Carlo Free Edition basically is the same software that everybody else gets, but you just have a limited amount of data. It goes back to 2004, but it's only 10 symbols, and it's only end-of-day data, okay? But it's perfectly free. Anyone who wants to just use 10 symbols and is happy with that, then this is what you need to get. It's free for you to use as long as you wish, and then you can also participate in the forums and discuss with the rest of the community. Next, we have Quanti Carlo Silver, which has unlimited end-of-day symbols, but these are end-of-day symbols, okay? Next, we have Quanti Carlo Platinum, okay? This one is unlimited in the number of symbols that you have access to, and they're 15-minute symbols. So this is really the one that most people will want to have, I believe. Okay, this is the one that I'm using on a regular basis. Okay, so, and with that, that is the introduction. Before I go into a demonstration, are there any questions?
No questions yet. I think, well, I guess there is one. Are VIX futures options available? I don't think you have futures yet, right?
I believe, I'm not sure whether the VIX options are there, but I will check, actually. You know, the funny thing with VIX options is that they often show up, and I think we may have actually purchased the options, but they're priced off the futures, and the futures data is actually sold separately. So I'm going to have to check on that one right now. That's one thing that we would like to support. Okay, I believe some people are saying they want to see the, okay, you're asking, is this a web-based? Oh yes, we have weekly options, we have monthly options, we have weekly options, we have monthly options, and we have quarterly options. So you can choose among all of those. So can you see my screen now?
Yeah, we can. I think people would like to see a demo.
Okay. Okay. Very good. So this is what you see whenever you look at what we call trade playback. This is a single trade. So actually, let me zoom out here. This is a single 15-minute trade, well, using 15-minute data. And you can see that what happened here was that the trade went along. You can see this is a calendar. This is one I built yesterday. It's very, very simple, and it's not very profitable, to be honest. but it's just something that I built as a sort of a demo. But you see that as you get toward the end of the trade that you have some adjustments, and the adjustments didn't really help you very much because you ended up losing money. But this is just to show you that I'm starting from the end, actually. This is the very last thing that you get to when you use Monte Carlo, and that is the playback of the trade that was done automatically. This is based on some rules that I'll show you in just a second. Now, you'll notice that there were some adjustments here at the end. It was frantically adjusting itself, and these adjustments were not effective, and you can tell by zooming in. I've got an adjustment that I created. I called it correct for delta 2 negative. And what I'm doing is I'm adding an iron butterfly here, but the iron butterfly, it turns out, is too narrow, so it's really not having the effect of balancing my deltas the way I would like for it to, and so it really doesn't get me out of trouble, and I end up at the end of the day losing money. But that's just by way of showing you that you can actually zoom in on each individual trade and see what's going on. You can see, in fact, the option chain down here. You can see what the prices were. You can see the deltas. You can also take a look at your P&L. Here, do we plan to offer 5-minute increments? Actually, no. Our data provider only offers 15-minute increments or 1-minute increments, and we haven't purchased the 1-minute data. The 15-minute data is what we've purchased at the moment. So you can see these are 15-minute increments from the time I entered the trade, and you can just go through this tick by tick, or not tick by tick, but it looks, sorry. So this is my profit and loss as a percent. This is my profit and loss in terms of dollars, right? And I can go through, and these are timestamps over here on the left. Now let me just back up a little bit, take a little bit of a bird's eye view. Now this, I was just looking at one row in this table. This is the table that's automatically generated from a back test, and it shows you that these are the expirations. I started in January in 2010, and I went all the way to September 2014. Someone asked, is the data the bid or the ask or the mid? And in answer to your question, we've purchased the bid and the ask, and from that we calculate actually the mid, but we also use slippage. So you have actually 3 different slippage settings that we can choose from. One of them is, I'll show you the slippage settings actually. When you configure your account, you've got margin, you've got Reg T, portfolio, and then you've got max theoretical risk. I usually recommend people to use Reg T. And then we've got slippage. I've got set to none right now, but you can set medium and large. And what this does is basically this will slip you off the mid, and it goes on a spread basis. It's not on a per contract basis. It's on a spread basis. So if I want to, let's say, buy an iron condor, and or sell. Let's say I want to sell an iron condor, and I've got 4 contracts per leg. That's 16 contracts. Well, that spread has a bid and it has an ask, right? And so the way we apply slippage is we apply it to the spread, not on the individual contracts. So Albert wants to know, would we be willing to offer 1-minute increments? You know, if there's a strong demand for that, definitely. what we're wanting to do right now is get this out in front of real traders and have real traders use this and tell us what they want, right? So and we want to, so far we've had a couple of beta tests. We've had some feedback from traders. They've told us what they want to see, and we've tried to implement the features and the data that people have requested. But you know, we're open to finding out what real traders want, and we want to be responsive to your requests. This is the equity chart. So once again, you know, I'm starting from the end with the reporting here. We've got trade playback. We've got this table of trades. We've got one trade per row. And then we've got this summary report here, which basically gives you like net profit, average return, your confidence intervals, your total trades, your wins, your losses, et cetera, et cetera. And we can add to this as well. This is just a start. Number of metrics that show you how profitable this trade was or how unprofitable it was. In this case, as I was saying, this is not a very profitable trade. But if I want to zoom into a particular, let's say, area of interest, I can do that. If I want to zoom out, I do this. This is all in the tutorials, by the way, folks. If you want to know how to do this, how to use it. Do we have a yearly subscription offer? We definitely do. Yeah, we do definitely have one-year subscriptions. You can subscribe month by month, or you can subscribe year by year. But there's a significant discount with the annual subscription, so that's probably preferable for most people. Another thing, you can export everything you see here to Excel except for the trade playback. That doesn't go into Excel. But the table here, the summary, all this information goes into Excel with the click of a button, and then you can analyze it. And David does a lot of this. In fact, David will have more to say about how he is automating all of this exporting of this stuff to Excel. Can I review adjustments, how to adjust? You know, how to adjust is actually there. It's a long subject. I mean, we could talk about that forever. And I would actually suggest that we have a session, like a 1-hour session on how to adjust. There's a very easy way to adjust. We have something called easy entry. This is a pre-built trade. Here we have a calendar, pre-built calendar, and what I can do is actually add adjustments. Here you can see I've added an adjustment down here. Let me delete this adjustment and delete this one. So we have, if I wanted to add an adjustment here, I can add it, and then it's the trigger. The trigger is, do I want to touch the upper expiration break even, or do I want to touch the lower expiration break even, a percent movement toward the upper break even, a percent movement toward the lower break even, that sort of thing. All of these triggers are pre-built for you, and this is one way of adjusting. And then what you can do is you can either reposition the calendar, or you can add a calendar in this case, and you can do it at the money, or a number of strikes above or below the current market, or a number of standard deviations above or below the current market. Now this is what we call easy entry. This is basically a point-and-click interface, and right now we only have calendar and iron condor in here, but we want to add more of these easy entry trades over time based on feedback from real traders. And this is really the quickest way to do this. Let's say I'm seeing a lot of questions flash up on my screen here, and faster than
Larry,
I can.
why don't you do this? Why don't you end up going through it, and then we'll come back to the questions, because otherwise I think you may end up getting too off track, and you won't be able to end up finishing showing the stuff you want to show.
Okay. Thanks, Jim. That's a good suggestion. So what I'm going to do then is I'm just going to do one more thing, and then I'm going to hand over to David, because David has really been our power user, and David has been really working with some real life optimization cases, and he'll be able to show some real life examples. But I'm going to show you just one more thing, just to give you an idea of how things can be done. What I have here is this is a blank trading plan, okay? And this is another way of entering a trading plan. What I just showed you was easy entry, but this is a different way. This is using what we call symbolic expressions. And what I've done for this demo is I've prepared a few symbolic expressions over here. These are trading rules. Let me show you up close. I'll zoom up a little bit. This icon means trading rule. And I've created let's see here, some exit rules. I've created an entry rule, enter trade, enter calendar trade. And let me just show you how this is built. I'm going to build this trade right now in front of your very eyes. So I'm going to drag this enter trade, enter calendar trade over into the entry rules. So there that is. Now, notice that I get the English language version of it over here. So you can confirm that actually what you put in is actually what you intended to put in. So now I'm going to put my exit rules in, exit at expiration week. So I don't want to stay in when it gets to expiration week, I want to close the trade. I'm going to exit at max loss, okay. Let's see that one. Okay, there we go. Exit at max loss, exit at target profit, okay, just dragging those over. And then I'm going to exit on too many adjustments. What I found the other day, it was funny, I didn't put a limit on the number of adjustments, and I noticed that the back test was taking a long time, and then when I got the result, I looked at it and I saw that one trade had 468 adjustments. So you need to put a limit on the number of adjustments that you make. Otherwise, it could take quite a long time to find out that you're adjusting too frequently. So now I'm going to add my adjustments. I've got one adjustment for, I've got one for delta 2 negative, and then I've added a little prompt here so that I can change it each time that I enter this. I've got this negative delta multiplier, so I'm going to just click OK and accept that. And then I've got this correction for delta 2 positive. All right. And this one also has positive delta multiplier. Okay, I'm going to accept that. And there you have it, ladies and gentlemen. This is a trading plan. You can see the English language version here, and I can just save it and run it right now. But you know, we're going to run out of time, and I want to leave some time for questions, and I also want to definitely leave some time for David's case studies, because I know that you're going to find those interesting. So I would like to just at this point hand over to David and end my portion of the presentation right here.
Okay, I've transferred the presenter to you, David.
Hi, this is Dave Wilt. Tom, can you hear me?
I can, and I can see your desktop.
Good, all right. Thank you very much. I want to thank everybody for this opportunity, and particularly I want to say thank you to Jim Riggio. He has been a huge friend of of Quanti Carlo, and what he has done for us has been more than we had any right to expect, and it's meant it's been hugely important for us, and I just want to publicly express our appreciation and
Well, thank you, David. I'll look for the check in the mail.
Absolutely, and say that at a minimum, he'll always have a free. He won't have to pay any annual fees. He may have to take us to lunch, but in any case, let me just give you a little background. Larry and I got together several years ago. I had approached this, and we both knew Dan Harvey. Dan Harvey got us together. I have a background in mathematics and statistics, and I was always been interested in looking at trading from a statistics and modeling standpoint. So Larry and I kind of agreed that I would evaluate or approach and investigate what could be done with Quanti Carlo to create, as what he said, a scientifically sound approach to optimizing options trades. I think that there's a lot to talk about, and each of these topics, as I'm sure many of you know, are worth hours and books on their own. I can tell that this is a group that would like to get to the meat of what I have to talk about, so I think I'm going to change this approach slightly, and I'm going to go right to this case study. And then we can perhaps come back and talk about some of the elements of this. I do want to say very quickly that this uses everything we've done, this process that I'm going to talk about, is based upon this concept of systematic trading strategy. I would recommend the book, but to make a long story short, Pardo talks about a fixed, tested approach to trading. It's different than, substantially different than the discretionary model that I think is prevalent in the options trading world, and I think that for most of us, and certainly for me, that's a huge challenge. I know there are people who can be successful, but I think there are just as many or more who can't. And so the idea here is if we can use statistics, if we can use testing, and we can make it feasible to evaluate strategies and identify optimal choices and approaches, that for most of us, the results will be better with reduced risk, improved returns, and I think, as importantly, an improved understanding of what you expect and simply the psychological benefits of that. In any case, so I worked on putting together an approach toward optimization, and I'm going to jump through some of this. But basically, what is optimization? It means testing a trade strategy to achieve the best results. Now, best is defined by the trader. What is best for one trader may not be best for another. And that's one of the powers of this tool, is that you allow you to pick the outcomes of a trade that might be interesting to you in terms of average returns or minimize risk or minimizing max drawdown or whatever it is, and then optimize to that. And you'll see how it's a process of identifying trade parameters that matter, that what you think are important, seeking the optimal settings for those parameters. And some of the things we've done in this in this case study, is to add and remove some rules, because we wanted to look at some ways, for instance, to have some contingent exits. What's a trade parameter? A classic one is days to expiration at entry. And there's a huge discussion around almost every trading plan. What is the DTE? Well, you can, with this tool, you can propose a set of values for DTE, study them, and then evaluate which gives you the best results, and whether or not, and this is tremendously important, whether or not any of those results are statistically significant, or whether you're simply looking at the random stochastic behavior of trades in a sample space. So let me move ahead to this case study. All right, I want you to remember this. This is a weekly rut trade. I think somebody asked if we have weekly trades. Yeah, we do, and a lot of the work I've been doing has been on weekly trades. There's just a great interest in it. All right, one of the things, of course, you always want to do is you want to look at the strategy as it currently exists, and you want to test it. All right? So this was a weekly rut trade, and it's a proprietary trade, so please excuse me. I'm not going to reveal all. I'm not going to open the kimono completely. But if you want to talk about it further, I'm sure we can and find ways to provide more information. So we were always run the baseline. So we had this basic trading strategy. We ran it with Monte Carlo Enterprise, which I'll talk about in a minute. And the average return per trade was $136. And this desirability index was 687. What is the desirability index? That's a standard method in statistics, in inferential statistics, and in modeling to create a single measure that reflects outcomes of interest to you. And in this case, this desirability index had 3 components. And again, they had to do with maximum consecutive losses, win rate, and a third, which I feel like I need not to share at this point. So the question is, we have this trade, we have a baseline, and the question is simply this: can we improve it? Can we find a revised strategy with statistically superior results? And statistically superior is tremendously important, and I don't want to sound like a geek or a statistics professor, but when we have results from any kind of a back test, or any test at all, but a back test, the first question is, are these results statistically significant? Can I be comfortable that when I run this trade again, or in the real market, when I put it on the real market, will I get the same result? That's the fundamental question you always need to ask yourself. All right, so there we had the baseline. All right, average return of $136 and a desirability index on a scale of 0 to 1 of 69. Okay, so let's just go right to the big reveal, and then we'll come back. So what were we able to do? What were we able to do? Okay, we optimized it on 2 outcomes. One was average return. Again, that's average return per trade. And the other is the desirability index, which is composed of these 3 components. Now, all right, so what was the average return when we started? $136 per trade. What was the optimized average return? $1,126 per trade. That's a 10-fold increase. And the desirability index on that optimized average return was pretty good too. Then we optimized on desirability. And you can see that the number there is 773, excuse me. You can see that the number is 773. And all these differences, importantly, are statistically superior. So what I'm saying is that Monte Carlo Enterprise and the work that we've done provides you a statistically sound, scientifically sound means to achieve significant, predictable, reliable improvements, quite frankly. And I don't want to overstate this, but if you can imagine a trade with very broad limits, we can plan it, we can optimize it. And I would say that, and this is just the tip of the iceberg, because there are a whole set of optimization tools and capabilities. But essentially, what I'm saying, this is a real-life example where we took a trade that had been used for many years. This is a well-established trade. The average returns you see there, and you can then see the average returns that we achieved through optimization. And actually, what's interesting is that we achieved average returns quite a bit higher than these numbers of $1,100 and $900, but they didn't put them on there because I couldn't be comfortable they were statistically superior. But some of the strategies achieved optimized average returns of over $1,500 and desirability indexes of close to 0.8. So, but those are not statistically superior, at least I can't be sure they are, and therefore I didn't want, this is a more conservative estimate of what you would get by applying this optimized strategy. And
hey, David?
Yes.
Excuse me for interrupting. I just have a question. Can you give the audience an idea of whether this type of optimization that you've performed would be feasible with manual backtesting?
Oh, no. Okay. That's a great question. Let me go back. Thank you for that. When we talked about what what optimization is, what does optimization require? What do you need for effective framework? There are a lot of ways you can imagine to do this. There are probably other tools. I don't know of any, but Quanti Carlo Enterprise is certainly one. We have created, just to be clear, we've created a tool which expands on Quanti Carlo. We have integrated that with R, which is a statistical language. But the framework that we've created requires 4 things, and one of those is an adequate sample size. What is an adequate sample size? I would say that you need at least hundreds, if not thousands, of individual back tests to get, and Jim, I've seen some questions too, and perhaps when we get done here, and I'll be done in a few minutes, we can come back and revisit some of those.
I think that would actually be best, because otherwise you won't be able to get your message through.
Right. So what is an adequate sample size? Based upon the work I've done, I would say an adequate sample size is hundreds and not thousands. On this, now, what do I mean? Let me be clear what I say. The back tests that we did for this case study were typically about let's make it easy, there were 2 years of weekly options. Roughly 100. It was closer to 90 individual expirations. So individual back test ran one strategy, and I'll show you what that looks like, one strategy over 90 weeks. Now, I want you to think about manually testing something over 90 weeks. We did that 10,000 times. Now, did we need to do it 10,000 times? No. We actually afterwards discovered that, and this is not unusual, we found that probably of those 10,000 back tests, perhaps 2,000 were truly significant in terms of optimization. But I think you need hundreds or thousands. I think to do that manually is, I'm not going to say it's impossible, but it's virtually impossible, because you're talking about testing 90 expirations times 100 or 1,000, whatever. So I think that a tool like Quanti Carlo allows you to get sufficient sample size so that you can have reliable results. You also need to, excuse me. You need to design experiments using factorial analysis. We can talk about that. You need to use inferential statistics, and you need to use advanced data modeling. These things together allow us to, thank you. Yes, thank you. Actually, that's my phone. I should have turned that off. I apologize. I thought I had planned for everything, but I hadn't. The sample size is terribly important. So the answer is, I think to get the kind of reliable, predictable results you need, it's very hard to do it, almost impossible to do it with manual testing. And I think Larry and I, that's what really drove us here, was we felt like we individually came to the same conclusion. We wanted reliable results we could count on. And the question was, how do we get them? And we both concluded that pretty quickly that we needed to automate this. And that's how we started, and that's how we got to where we came.
Now, David,
yes.
Before you move on though, one of the things for the audience, when you end up doing these case studies, I assume from the name of your product that you're using a Monte Carlo simulation model.
No, actually we're not. We're still using that step. That's what we want to use. Initially, we're using historical data, but the way we add, and ultimately, Jim, and this is a discussion for another day, but we want to add, and we plan to add synthetic data, and we could talk about how synthetic or Monte Carlo data. But to your point, and again, I don't want to get too deep in this because it gets really geeky really fast. But I don't know if anyone in the audience is familiar with R, but R is a tremendous product. And again, Jim, we were talking about Pat Ryan, and it was one of Pat's kind of off-the-hand comments. you ought to look at it. But make a long story short, what some of the models in R allow us to do is essentially tweak the data we have and treat it almost as and add a Monte Carlo or a random element to it. And essentially what we do is we use multiple models. We then evaluate the data set, the data, we have a time series set of data. We evaluate it multiple times. And we can use a number of techniques, bootstrapping and some others, that allow us to essentially understand that data, treat it as multiple data sets rather than one. It's an incredibly powerful tool. Yeah,
right.
Go ahead.
Just in English to our audience and our members. The reason why this is so important is that you can't use a pure Monte Carlo simulation. For those that don't know what it just means that they randomly go in and they pick the data out of a data of how much everything moves. You guys know that we've talked about what the daily ranges have been, both in like the first 3 quarters of last year and then what it's been basically since December. And we've seen the daily ranges in the SPX and the RUT be much, much larger. So what ends up happening is that when the markets start to end up moving, the characteristics, or what some of the guys like to call the regime of the markets, end up changing. So it's so important to be able, if you're going to do synthetic data or you're going to be able to do any type of modeling, not to end up fitting it into do a curve fit of what data you end up having. It's so important to be able to take a better sample set, but you can't just take it randomly because that doesn't end up helping you either. So this approach is a very, very sound approach, and I can see how not only will it give you a good back test, but it'll give you a good set of rules for what will actually work in the real world going forward. And after all, isn't that what you do it for?
Yes, absolutely, and that's a great insight. And I don't want to go on too long. All these topics are to me very interesting, but they're also very profound. But to make one thing that I learned, to talk to Jim's point, we have here something called a slide that talks about the bias variability trade-off, and that's just another term for curve fitting. And the point that Jim makes is exactly right. When we do tests of any kind, we get really excited if we can model what we call the training data. That is the data we have. So we train a model on the data and we get some very high metrics. And with today's models, you can almost get a perfect model that perfectly replicates the training data, the data that you are using to what we call train the model. But as Jim says, that's the easy part. The hard part is to create a model that gives you a view into the future and gives you reliable predictions and reliable strategies that you can make money with in the future. And one of the good things about these models is that they have the built-in capabilities to balance this trade-off. And so what they've done is they've taken this kind of general concept of curve fitting and they've parameterized it to the point that we can now understand what it means to trade between an accurate training model and an accurate model that perhaps is a little less accurate. Our model is a little less accurate now, but that we think has the flexibility and the power to be more effective going forward into a market that inevitably, the only thing we know about it, it'll be different than any market we've ever seen. So to make a long story short, all this is doable now. If someone in the audience has a trade that they want to optimize, ultimately we want to offer this as a service and as a version of the tool. But I know that Larry and I are looking for opportunities to continue to apply and develop this process. So if somebody has a trade that they would like to subject to this optimization process, I would be personally pleased to have the opportunity to talk with somebody about that and figure how we can move forward. I am absolutely convinced that and this has less to do with us, Jim, or Larry, and I think it has to do with kind of the inevitability of this direction. I think 20 or 30 years from now, that people will look back on this and say, well, that was easy. That was a no-brainer. I think that what we're really doing here, and then I'll shut up, is taking a series of methods and techniques that have been applied in other industries and bringing them to the options trading space. And what we have here is a tool that allows us to do the tests fast enough and sufficiently enough to apply these statistical models and give us the kind of predictive capability that has been achieved in other industries. So I think with that, and Jim, unless there's something else, I think I'll pass it back to Larry and say that I hope this hasn't been, I hope this has been helpful, and I hope it hasn't been too confusing, and I'm happy to talk at length with anybody about it, because I'm sure in talking with them, I'll get some new ideas and learn some more about what we can do.
You know, I find it really interesting, and you know, there were a lot of questions that we'll end up going through. And Tom, I don't know if you've been monitoring them. I know Tom does a great job of monitoring them. But a couple of quick points, and you know, the thing that I end up seeing here is that I had done a lot of you know, we've talked offline, done a lot of IT work and data work before I was doing. And being able to end up doing that, basically that relationship modeling, being able to end up seeing what goes on and understanding the characteristics of the way one stock and their options pricing might move versus another. You can't just pick up a strategy and move it over. So being able to end up seeing the differences in the data and being able to end up modeling them out is absolutely critical. You know, I know that we were talking on different WebExes earlier, where people would talk about, you know, when do you start to end up taking your profits? You know, do you end up starting to take things off early? Being able to end up taking a look at the data and what you can end up scanning on, and realize that you guys are just building this thing out. But, you know, one of the things, like, for example, a few weeks ago on Thursday, we had Bill Viscont from EAB, who's been an options trader for about 25 years. He started on the floor of the Philex, and he's done a lot of really, you know, great work. We were talking, and he would talk about how just simple iron condors, where they had a backtesting system, a dumb backtesting system, not a smart one like you guys have, and they just run them throughout the entire life cycle of their trade. And what ended up happening is that in lower environments with steeper put skews, they had been doing this so long that they knew that in the months that it failed, okay, or you know, they didn't have the profitability that they once had. They were able to end up seeing that. In something like this, the more capabilities you have to start to look at nuances of the options data and the statistics around them, things like skew, those things become very interesting, because what is happening, you know, I can see the vision that I end up seeing is that, oh, when we have this level of the current market, you know, the IVs are here, the skews here, based on the underlying that we've tested, that we find that, you know, trade A works better than trade B, or, you know, we'll put on the trade, but we'll use adjustment sequence 1 versus adjustment sequence 2. And to me, the single biggest point that makes some of the great professional traders as good as they are is that they've been doing this so long that they know that inherently, not mathematically. They couldn't be figuring it out on a different stock, but they'll know on their index of what they end up doing. Here, being able to take a scientific to be able to figure that out, I think ends up really, you know, if done properly, is that the big hedge funds have, you know, practically any advantage over you with all of their quants that they end up having, because of how powerful this could end up being. I mean, it really is. You know, with some of the really interesting things that I think about, we have in the community a bunch of different trades, and I'd be more than happy to put up a couple of them, and we'll talk offline. But
Right.
To take some of these standard trades that we've done with the set of rules and to see, you know, they optimized. You know,
Right.
why does, you know, individual A not trade it as well as individual B?
Right.
It's to me, it's just great.
Jim, thank you. Because I don't want to interrupt. Let me just show you one thing. If you can still see it says I'm still sharing my desktop.
We can.
These are heat maps. Now, I don't want to make a long story short. You talked about this was an iron condor, right? All right. With that, this is up there. Let's look at average returns for a minute. If you look at this heat map up in the right top left, you notice something called NSDMC and NSDMP. make a long story short, that's the positioning of the short and the long. What this testing showed us, if you want to optimize average returns, which I agree, which I think most of us would say, optimizing that without some other considerations is probably not wise. But what this showed unequivocally, and if you look at this very dark red spot here, you do not want a symmetric condor. You want in this particular strategy to optimize on this outcome, you want the put to be a lot closer to the money than the call. That is, as you can look at here, if you look at that red, that dark red in the bottom of that upper left heat map, that was what we discovered, and it was consistent time and time again, and it is probably the single most important factor to making this trade more profitable. And it's because, and I had never guessed that, and I don't know, I was surprised, but you end up with these non-symmetrical trades. The other thing that we found, to your point, Jim, is that we did add an exit, contingent exit, that had to do with capturing profit. And we found that the optimal way to exit for profit was about 80 to 90%. If you could earn 80 to 90% of the credit on your condor, get out. But the other thing, and then I'll shut up, is that if you look over at the desirability heat maps, you notice they're different, and we can talk about them later. But what this tells you, and this is something terribly important, if you optimize if you choose a different outcome, this kind of study can show you that the optimal settings, the optimal strategy, whatever you want to call it, will be different. And without taking a lot of people's time, if you just take a look at these heat maps, you can see that they're different. And really what they're saying is, if you want to optimize average returns, here are some ways to start. Here's some good areas. Here's some good regions. If you want to optimize desirability, the regions are different. And I don't know that, I mean, it seems to me that this approach allows you to discover this kind of stuff. And it reduces so many of the uncertainties we have about our options trading. So anyway, I just wanted to share that, and thanks.
Hello? Yeah.
Oh, I'm sorry.
Yeah, Jim, I'm sorry.
Do you want to start on some of these questions?
Yeah, sure.
Okay.
So you want me to unshare my screen, Tom? Excuse me.
Yeah, we don't have to see it if you don't want to.
No, that's fine. Okay.
Okay. Some of the things is, we talked about, and I'm just going to end starting from the top. So there are different goal versions, okay, and the number of symbols and stuff, that's all listed on their website. There are a couple of questions about those. The application, is it web-based? Is it downloaded? I'd imagine that you guys run stuff over the server, because the amount of number crunching you guys are doing, it must be just massive.
Right. Larry?
I'm sorry.
No, but I can answer that question. The answer is that right now it's a simple Java client, but it's very lightweight. 90% of the work happens on the server, which is in the cloud, and so therefore the computer requirements are modest. I will say, based upon my personal experience, be prepared for plenty of storage, because you're going to want, when you run these tests, because it's so easy to do them, you're going to do lots of testing and lots of back testing. You're going to get lots of spreadsheets and other kinds of things. So have a place to put them. But other than that, the demand is very modest. In terms of our computer
that was one of the questions.
Yeah,
there was a bunch of so just space to be able to end up running your results, and your results end up going out into different areas, and you end up talking about you can put them into spreadsheets. Tom ended up giving us some of the things in here. Okay, here. Will you be integrating Monte Carlo features? Okay, features you built in R into Monte Carlo, I'm sorry.
Well, certainly a lot of the lessons that David is learning are going to be things that we plan to feed back into the mainstream product. And that is something that's planned for version 2. What we're releasing today is actually version 1.0, which is doesn't include all of these bells and whistles that David has been building.
Okay. And I just lost all my questions. Hang on here.
I think it was Amy asked, do you support all the main indexes, and do you have ETFs?
We do indeed have ETFs. We have, altogether, we've purchased the U.S. equities, equity indexes, the ETFs and ETNs. So those are actually in the process of being installed right now. The installation is a very computationally intensive process. So we're installing one symbol at a time, even though we've purchased something like 4,200 or 4,400 or something like that. We're installing them, and we're up to about 500 right now that we've installed. And we've started with the ones that are the highest volume, which presumably means they're the most popular. So, and then we're working our way toward the less popular symbols.
And, Larry, how far does the data go?
Goes back to 2004 January.
Okay. We talked a little bit about this, but Matthew asked about how do you end up running multiple runs on the same data? I don't know if you guys want to end up expanding a little bit upon what David, what you and I ended up talking about just a few minutes ago.
Essentially, a strategy is a combination of parameters and values. You know, Jim, I have some stuff I can show about that, but to make a long story short, what we do is we identify parameters of interest, like let's take DTE, and you say, you know, I think I want to test 30, 35, and 40. And then you say, I also want to test exits, let's make it easy, 10 days, 8 days, and 5 days. So each of those generate a combination. Then basically what we do is we test each of the combinations, and in Quanti Carlo Enterprise, we have a way to automate that. So basically we define the combinations, we press a button, and then all these back tests occur. We do one back test for each combination. And a combination allows you to test, to see the interaction between, say, DTE and the exit date, or whatever other parameters are of interest. In the case of that RUT weekly study, we had about 8 different parameters we studied. So it was day of entry, excuse me, not day of entry, but time of entry, time of exit, placement of the short put, placement of the short call, and also then some exits about based upon movement of the underlying or capturing, limiting max loss and max profit. If you then define values that you want to test, like again, DTE of 10, 20, and 30, then each of those gets wrapped up to a particular combination, and then the important thing about optimization is that you can define those combinations quickly, and then you can run all the back tests at once, and then you can capture the results of those back tests to compare and contrast as we do, and that's what we use R for. You know, I think that's probably easier to show. And Jim, maybe, you know, when we have some more time, we could go into this in more depth.
Well,
but
we're definitely going to have to. Right? We're going to definitely have to come back because there are just way too many questions. You know, which is great, right? People are showing a lot of interest on the heat maps. So the heat maps part of the Quanti Carlo product.
They are part of Quanti Carlo Enterprise. To make a long story short, yeah, the Enterprise. And what we can do, essentially, we can define the factor values and define the parameters and the values. All right. So you sit down with a trader. Say, okay, what are the parameters of interest? What are the values that you want to test? That automatically generates a set of combinations. You basically put that additional information into Quanti Carlo Enterprise. You press a button. Out on the other end comes a report of some, I don't know, 18 or 20 or 30 pages, depending upon the nature of the analysis, which reflects all the modeling and the analysis in R, and then that gets wrapped into something called Sweave, and it generates this report. And I can show you, Jim, I can send one to you, and you can see what you get. But essentially, it's an integrated process that can actually go pretty quickly, depending on how many times then the trader wants to revisit it after you do a study, and then you have a certain degree of optimization or not that you've achieved. But yeah, so all those things end up in the final outcome. And as we work with people, we can add more. The power of R is literally unlimited. It's just a matter of finding things that are truly useful.
So in a lot of these things, okay, what I've always seen is, in terms of model, is that they're basically changing the shape of the implied volatility curve. You guys have actual data on that. Is that what you're doing? And basically you're seeing in different moves, here's the way the volatility curve moves in this environment versus in that environment, or are you just using straight data? Or, because most of the big institutions that I've ever talked to, they're always looking at basically, here's what the vol skew curves and the term structure look like now. As we go through a move, here's the way it ended up moving from, point A to point B. Or are you guys taking a different approach?
I think that's certainly the one thing that we'd like to do. One of the main things we'd like to do is we would like to, these are averages, right? And I see a very interesting conversation from David Stewart. It's a very interesting thing. I think that's an important discussion but anyway, having said that, let me get back to that. I think that what can be done next, Jim, is to what Larry and I call stress test. Essentially now what we do is we run these tests across, let's say 90 or 100 or 2 years or 5 years or whatever. What you'd like to do is, in using Monte Carlo data, you'd like to stress them. You'd like to say, let's see what happens in a period of high volatility or low volatility. Let's see what the impact is. I think ultimately that's the next step, so that when you come to you have a strategy, you know how you tweak it for a volatile market, a low volatility market. The other thing that we can do, of course, is look at, we can test any kind of skew. If we can measure it, we can test it. So we can say, let's test let's test how this behaves with certain kinds of, or let's see the impact of different skews, or let's see the impact of selecting certain skews as a requirement to enter or to exit or something like that. So the answer is that can be done, at least so far, it has to be done explicitly as a factor that you would look at, and you would say, I want to test this. Ultimately, if we can stress, we can then pick those, we can define an environment with high skews or low skews, and then see how the strategy performs. Does that make sense?
It does. I know that you're very, very sensitive not to end up making these things go marathons. Every time we answer one question, and just get 6 more pop up. At this rate, we're never going to be done. How much longer do you want to end up going? And you guys are reading the questions also, I know, as we go through this. Or should we just end up scheduling another session where we can end up just going through and talking about this?
Well, actually, Jim, Larry and I have set up some what we call Quanti Carlo education within Capital Discussions twice a month. And the first one's going to be February 17th on Tuesday at the same time, 6 p.m. Eastern, because Larry does live in Japan, so we don't want to have him get up at 5 o'clock to do a little training session. But we're going to be doing...
Jim, yeah, go ahead. I'm sorry.
Details of the software.
A
couple of questions here I'd just like to answer because I have things I've looked at.
That's what I was going to end up asking you, especially Dave Stewart.
For instance, let me see. Somebody asked about how long does the back test take? That's a good question. On this, and of course it depends on a lot of things. It depends on how much time, what time period you're testing. It depends on whether you're using 15-minute or daily data. It depends, as Larry said, on how many adjustments you do. But the RUT study, which was roughly 2 years of backtesting, each of those backtests would take about 45 seconds. All right. Now, in the new version that I'm developing I'm revising this product, or not product, or process, whatever, the tool, to use multi-threading. So now we can run those back tests. Okay, 2 years of weekly. Okay, let me be clear. 2 years of weekly RUT expirations at 15 minutes. We can run each of those back tests in 10 seconds.
And David, let's clarify that with Quanti Carlo Enterprise, you're using a dedicated server, so you're not sharing this with everybody else.
That's true. Thank you. Yes, exactly right. Otherwise, it depends, but you can typically do these things in minutes, right, Larry? I mean, even on a shared server, it seems to me.
Yes, definitely. And if you, for example, one of the things I like to do is I like to run it on just one timestamp per day when I'm starting out, and that goes within a fairly simple trading plan will run over 10 years of data in less than a minute, with monthly expirations with one timestamp per day. And then once I've got my trading plan working the way I like it, then I'll switch it to 15 minutes, 15-minute increments, and then that can take as long as, if you're doing 10 years and you have several adjustments, that can take like 5 minutes for one pass through.
Right. I think that the other thing I would just like to suggest is, testing is one thing, and this is what Pat Ryan kept beating into my head. Testing is one thing, so we can do a back test similar, not fundamentally different from a manual back test. But it's faster. Right? The important thing, it seems to me, is the equally important thing is to interpret those results. And that's where R comes in, some of this modeling and the heat maps and other things. Because
that's the difference between information and knowledge.
Yeah, and I think that, I certainly I don't even have 1% of the answers, but I'm just reflecting on my own experience. And I think that one of the things that this community could help us do is come up with ways to, what are reliable ways to predict? And I understand that there's some folks who may take exception to the concept of predicting behavior in the option space. And I don't understand why they'd feel that way. And that's a discussion we need to have. I will say the other thing, Jim, that I noticed, and this is something I do believe, and I think every option trader could benefit from, I mean, I don't know, that sounds a little ego-driven. I think one of the things that options trading could benefit from is a dedicated effort to reduce the variability of the results. Because the higher the variability results, the lower the value of the predictions, and the more data you need to achieve reliable predictions. And this is, I think, Jim, would be an interesting conversation to have within the community about how you can create trading strategies that give you adequate results, but control the variability so that we don't have these huge standard deviations. And what I found in some of these studies I've done is that and I don't want to sound too, I'm not confusing anybody, but when the standard deviation of your results is higher, let's say, than your average return, it's very hard to get a signal out of that. And I think that I think that could be a useful area of research, finding ways to reduce the variability while maintaining good returns.
I agree with that totally. One of the things, I remember listening to some people talk about doing their weekly tradings, and there was an argument about whether it was better to end up entering on Tuesday afternoon or Wednesday morning. And to me, that is just it is just totally ridiculous because the variability of that has to end up doing with the markets. It has to, they're missing the total point when you end up looking at some things. I think it's really, really important to be able to take a look at the factors that end up giving you, the word is robust, right? They give you robust returns, which means that you don't want to have any strategy where you tweak one little tiny parameter and your results end up going, huge. One of the things that we would end up taking a look at all the time in results, okay, when we would end up having different risk-based metric stuff that would end up going into a three-dimensional surface map, what we would end up taking to look at was not the highest points, okay, not the greatest returns. I didn't care about the greatest returns. I was looking at like the swatch of land on the surface that would end up being the highest and the flattest. If I could find a high plateau, which meant that if I moved the variable around a little bit, I was still achieving good results. Those were the strategies we wanted to run. We didn't want to end up running the ones where, at one point you had the absolute highest, and then you move a tick over, and you end up having a losing trade. That's curve fitting. That's curve fitting.
And I think that's a great insight. And and that's actually that's a good thought. One other point that somebody asked, I noticed, because this is important, we've been talking about this, I think there was a question about could you test or could you create a trading strategy that incorporated volatility? And the answer is absolutely yeah. And if we can measure it, if there's a measure for it, then we can incorporate it. I mean, you think,
how
if it's in the data.
The other factors? There was also questions about technical analysis or other things.
Yeah.
Did you end up?
Yes, now we have some technical analysis, and Larry, and I think we assume that there will be more of that. So we have a few indicators now when we thought we'd just try to get it out here and see what traders thought. But we also put in something called a pre-entry rule, because it was clear to me that after working with some folks that they always want to they want to get a sense of the market before they start placing their trades. So we have some ways within the tool to look at the state of the market and then help you extract some information and then use that as part of your decision to enter. And some of that is encapsulated in specific TA, and we could add more. I mean, I think we're just waiting to get some feedback as to what kind of technical indicators people could use.
Okay, so Tom, I think that we have had more comments in this one WebEx than we may have had in the entire history, okay, of capital discussions. Everybody.
I think what we're going to have to do is I'll compile all the questions into a document and then let David and Larry answer them, and then we'll make that available to everybody so that everybody's questions can get answered.
I think that would be absolutely great.
Great. And I think, Jim, one thing I just want to do, because I don't, and I know Larry feels the same way. We get excited about this. I don't want anybody to think that we're trying to present ourselves as all-knowing or all-knowledgeable. I think that Larry said something that when we started, we want to get this in front of the people because there are a huge number of smart people out there. We know, or we believe strongly, that if we can engage them, if they will share with us their views of Monte Carlo, good, bad, and indifferent, if we can learn from them, we will be able to continually enhance this product. So the engagement with folks and the learning that we can anticipate from engaging with them is invaluable, and we appreciate the time, and we appreciate people's questions, we appreciate their comments, because that's so important to making this product and making the community more successful, and I think that's what we really like to see. So I want to personally thank everybody and say I look forward to the continued dialogue, and I'm sure that we're going to, I'm sure Larry and I and Monte Carlo and IOTA will be better for it.
Tom, when's the next meeting? What can everybody end up expecting, and how do we end up picking up this actually very, very interesting comment? And the next time we end up doing this, what I'd love to be able to end up doing is maybe even having a couple people come on. When you end up having a few guests who are very, very knowledgeable, and you end up having a back and forth discussion, it ends up being so much, I think, more interesting and educational for folks. When you end up doing the question things like this, I mean, it's amazing, okay, the number that are coming at us. And I know that we only touched on a few of them, and I apologize that we weren't able to get to everything. But Tom, what's the schedule? When do we have our next Quanti Carlo, either education session or WebEx?
That'll be on Tuesday, the 17th of February. And actually, if you go to the schedule, maybe I can just show it real quickly because it doesn't take that long to do. You can actually filter out on the calendar all of the meetings that you want to see. So, okay, so, and we can set these dates farther in the future, but just so you can see, this is the schedule of when these education sessions are. So, twice a month, the first and third Tuesday of the month at 6 p.m.
Okay. What we're going to be doing is you're going to be putting together all of the questions. What I'd end up saying is that if there's enough interest, I would love to end up having just another discussion. Maybe have a couple of people come on. In your questions, okay, write an email to Tom, and, we'll end up seeing what we can end up putting together. But, guys, let me tell you, I think that this is just really, really interesting. I think that you're touching on an area that is very interesting, that people have a lot of strong feelings about. A lot of people have done a lot of work in this area, and I think that as a community, by working on this, I think that it's going to end up being potentially just absolutely great for our members, and we really, really look forward to working with you with hopefully a very, very long and beneficial, partnership for all of our members as well as yourself.
Well, thank you.
Jim. That's very kind.
You bet. And and thanks, Tom. And we'll stand by, and I look forward to seeing the questions, and we'll do our best to answer them.
Great. And we look forward to seeing you soon.
Great. Thanks a lot.
Thanks, everyone, for sticking with us, and we'll see you next time.
Thanks all.
You bet.